Hello and welcome to the ESOP Centre's 8th Share Plan Symposium. The event is hosted by Baker McKenzie and I'm Juliet Wigsell and manage the ESOP Centre for the N Group. This is one of 9 presentations that will inform the 4 panel discussions at the in-person section of the symposium. This talk will be discussed as part of the panel on all employee and global share plans. Many thanks to Graham Muir of CMS, who will shortly tell us about recent and prospective developments in all employee share plans. There will be ample opportunity to put your questions and comments to the speakers at the symposium on the 5th of June, and we look forward to seeing you there. It's now my great pleasure to hand over to Graham.
Thank you, Juliet, and hello. The eagle-eyed amongst you will notice the title to this talk has changed slightly from the original publicity to add in the reference to prospective developments. That's because I think there will be quite a few probably in the next year or two, and it's worth spending a little bit of time talking about those. But in terms of, next slide, please. In terms of recent developments, I'm going to be talking about the latest Investment Association guidelines, and there are a couple of concessions there on all employee plans. I'm going to be talking about the SAYE changes in bonus rates and their impact, the impact on SAYE participants of the reduction in the capital gains tax annual exemption over the last few years, a brief section on statutory neonatal care pay, the relaxation of CSOP conditions, and there's a recent trend relating to that, and then lastly, I'll make a brief mention of Pisces, the new government-sponsored, lightly regulated platform for secondary share markets in private companies. In terms of prospective developments, I'm going to talk a bit about the Treasury call for evidence in May 23 and the attitude of the new Labour government to employee share ownership and opportunities for change that may now result from that. There are also new rules on employee ownership trusts, which is probably an all-employee plan, but you will have had a separate webinar on that, so I won't talk further about those. New slide, please. The Investment Association remuneration guidelines are published most years and set out the Investment Association's view on what's acceptable for share schemes in listed companies. The last version was published in October last year and contains a couple of interesting derogations for all employee share plans. The general rule that grants of awards must be made within 42 days after the announcement of results has an exclusion for employee share plans, for all employee share plans, which may well be of relevance and help. There's also the general prescribed 10-year life of long-term incentive plans, with renewal requiring shareholder approval to go beyond that length of time. Again, that excludes all employee share plans. I'm not sure how useful that will in fact be, because I think it's a good idea to review your share plans at least every 10 years in any event, but at least one wouldn't be in breach of the guidelines. There's an extended dilution limit for discretionary plans to 10% from 5%, and that in fact could have a negative impact on all employee plans. Previously, there was 5% ring-fenced for all employee plans, with only 5% available for discretionary plans. So the effect may be that any all employee plan awards will effectively reduce the amount available for discretionary plans, and that may reduce the amount of all employee awards made, which obviously would be unhelpful. But it's not yet clear. These guidelines have not yet come through in full force, as it were. I made a reference on the slide there to all employee share plans. There's no definition in the guidelines of that. But there is a trend towards plans extending to all employees, even if they're not SIP or SAYE, these tax-advantaged all employee plans. But it's unclear how far the Investment Association would allow the rules, these new concessions, to be applied in those circumstances. Next slide, please. The SAYE changes in bonus rates. With the original idea of SAYE, and it was introduced in, I think, 1984, was that you would save for 3, 5, or 7 years into a savings account, and at the end of that period, you'd get a tax-free bonus, and if you had to leave in the interim, you'd get tax-free interest, and that proceeds of that account would be used to fund the exercise of the share option. The basic concept remains the same, but for many years, whereas you all know interest rates have been very low, the rate of bonus and rate of interest payable is zero, which obviously is unhelpful. Since August 2023, we've had much higher interest rates, and there have been positive rates of bonus and interest for SAYE. In addition, there's now a changed method of calculation, so the bonus rates reflect all changes in the Bank of England base rate, which, as you also all know, is changing quite frequently these days. Every quarter there seems to be a change either upwards or downwards. From the 23rd of May this year, you now get 0.7 of a month of bonus contribution for a 3-year contract, and 1.9 months for a 5-year contract. It's no longer possible to have a 7-year contract. And then there's 0.3% of interest also tax-free for early leavers. And those amounts are determined on a formulaic basis by reference to whatever the base rate is charged. I've referred on the slide there to the impact of the 3-month starting date limitation, and that limitation effectively requires the first payment to an SAYE contract to be made within 3 months of the invitation relating to that, since otherwise a change in bonus rate could operate to terminate the contract. This is not unmanageable, but it does mean that invitation processes need to be reasonably quick, and that scheme administrators need to be aware of this circumstance to make sure that the timings work. Next slide, please. As you'll probably be aware, in recent years, there's been significant reductions, successive reductions in the capital gains tax annual exemption from more than 12,000 a year and then from 2023 it's reduced to 6,000, and in 2024 it's reduced to 3,000. And the effect of that for share scheme, SAYE scheme participants is that whereas previously very few would have a taxable gain because the gain would be within their annual exemption, many more will now have a taxable gain. And that in turn means that there'll be a requirement to complete a tax return, which many will never have done before, or to use the real-time capital gains tax service provided by HMRC for reporting and paying capital gains tax. That's actually the only real concession made by HMRC to try and cater for this huge number of people who will be required to pay capital gains tax than would previously have done so. And perhaps skipping to the last point on the slide there, that's one reason why it perhaps is now time for an exemption for gains arising on SAYE shares. The administration is hardly going to be worth the tax raised, we would think, and it would certainly simplify matters and make SAYE more attractive if there were a capital gains exemption specific to SAYE. I've also referred on the slide there to transfers into pensions, and it's slightly unfortunate there is inconsistent revenue guidance on this point, some of which suggests that if you transfer your SAYE shares into a registered pension plan within 90 days of acquiring them, there'll be no capital gains tax. Well, that's in fact not correct. That is technically not the right answer, and there's other guidance that makes that clear. But we are trying to get that resolved and that inaccurate guidance removed. Next slide, please. From 6th April 2025, the Neonatal Care Leave and Pay Act provides for new pay entitlements for parents whose babies sadly require neonatal care. Those entitlements are related to the amount of taxable pay you have, and that may therefore mean that your entitlement will be prejudiced if you buy partnership shares under a SIP, because that reduces your taxable pay. That's just the same as currently exists for maternity pay, statutory sick pay, and so on, but it is now expressly extended to neonatal care pay. And to prevent unfair prejudice arising, or at least arising unknowingly, companies are now required to give a notice setting that possible consequence out to any employee invited to buy partnership shares in a SIP. Next slide, please. The reason I referred to neonatal care is that it's the only actual statutory change that's taken place in recent years in relation to SAYE or SIP. But in 2024, the conditions on the types of share which can be offered under a CSOP plan, and a CSOP is a different type of tax advantaged plan, to make CSOP now much more feasible for private companies. Now, CSOP is not strictly an all-employee share plan because there's no requirement to offer participation to all employees. But there is, since the change in 2024, a new trend that we've identified that companies with large workforces frequently use CSOP to grant awards to all employees. The one reason for that, there is no limit on the overall participation in a CSOP, no overall size of plan, and that is in contrast to EMI. And there's also no limit on the companies which can qualify to grant CSOP, again in contrast to EMI, which can only be granted to SMEs, which are trading companies. There's a 60,000 individual limit, but if you're benefiting a large number of perhaps lower paid employees in your workforce, that 60,000 will probably be more than adequate. So CSOP has become, in part, used as an all-employee plan. It's certainly simpler than SAYE and SIP and less expensive to run. Next slide, please. PICES, you will have heard of the Private Intermittent Securities Capital Exchange system. There's been a lot of press about it in recent months, and that is being introduced this year. There are various tax and share scheme considerations that come from this new regime, and it's been the subject of quite a lot of lobbying. And there was a reworked technical statement issued by the Revenue on the 15th of May, so not long ago. It promised to have sections in it about SAYE and SIP, but I'm sad to report there's nothing helpful in those sections. It merely reports how SAYE and SIP work and says that PICES, there's no derogations in PICES for SAYE and SIP, so I'm not sure how helpful that is. For completeness, I mentioned there a small change to the PICES regulations, which clarifies that all trustees of SIPs operated by PICES companies can participate in PICES arrangements by buying shares under those arrangements. Previously, there was a slightly odd qualification which didn't seem to be well justified, but that's been removed following representations made to the Treasury. Next slide, please. That's about all I'm proposing to say about recent developments as such. But as I mentioned before, I think there may well be that may well be about to change. I think there may well be some change we see in all employee plans in the next couple of years. The Treasury issued a call for evidence in May 2023, and the process for that closed in August 2023. Now, won't have escaped your notice that's nearly 2 years ago, and there's actually been no response from the Treasury in those 2 years. But there was a suggestion at the most recent HMRC share scheme forum that something may happen at the next fiscal event, by which one assumes they will probably mean the autumn budget. Whether that is just a comment on a Treasury response or perhaps suggestions for real change, we don't know, but watch this space. But I thought it was worth mentioning here, in light of that, possible areas of improvement for SAYE and SIP, which I know from responses that I've seen to that consultation. were raised in response to the call for evidence. I won't go through these in any detail. There are rather a lot, as you can see on the slide, but just going through them quickly. It would be possible to simplify and ameliorate the accounting treatment of SA-WAE options, which is currently A, rather complicated, and B, rather harsh. The tax treatment of SIPs itself could be simplified, and perhaps in particular, that all tax benefits could be available if you hold your shares in trust for 3 years. Currently, there's a 5-year period required, and that doesn't fit in very well with current employment trends. They tend to be shorter than 5 years. A simple change would be to increase the annual limits for participation in SA-WAE and SIP. Those have not changed recently, and they certainly haven't kept pace with inflation or wage inflation. Contributions to SA-WAE, to your savings account that I referred to earlier, are currently made out of post-tax earnings, so already taxed income. There's no real policy reason why that shouldn't be changed so that it could be out of pre-tax earnings, and that would mirror the position with contributions to SIPs to buy partnership shares, and that tax benefit would encourage wider participation. To simplify the process and reduce complexity and cost, the Treasury or the Revenue could publish model documentation for SA-WAE and SIP, which would make it perhaps a great deal easier for smaller companies to participate. We're all aware that the gig economy is increasingly a part of the world in which we live, but the plans currently only allow benefits to be applied to employees. There's also very much a trend towards employers of record, and again, you can't participate in an SA-WAE or a SIP plan via an employer of record. There seems no reason in policy why those plans shouldn't be extended to allow gig economy participants to participate. An easy change might be to ease the restrictions on the shares which can be used for SA-WAE and SIP, in the same way as happened for CSOP a couple of years ago. That would make those schemes much more accessible to private companies. You could allow targeting towards lower paid employees. Now, both SA-WAE and SIP have rules that say all employees must participate on similar terms. The concept behind that was to prevent the benefits being skewed towards higher paid employees. But there seems no policy reason why that you shouldn't skew the benefits in favour of lower paid employees. That would seem to accord with the policy behind all employee plans in the first place. And there's an increasing trend amongst companies to actually want to do that. Again, reflecting the way that the employment market is working these days, people tend to work for a company for less long than they used to. Would it be possible to allow for a 1-year savings contract for SA-WAE in addition to the current 3 and 5, which more closely reflects how employees work, particularly younger employees and particularly perhaps in high-tech smaller companies? People move around more than they used to. Another benefit would be to change the treatment of leavers, again, which would help with that increased mobility in the employment market. Currently, the rules are very prescriptive about how the tax treatment works on SA-WAE and SIP in those circumstances. And then lastly, coming back to a point I raised earlier, the capital gains tax exemption for SA-WAE shares. There isn't one currently. Perhaps would be useful. It would certainly encourage SA-WAE, we would think. Next slide, please. I started this slide with the attitude of the new government to employee share ownership, and it does seem that that attitude is very positive. All that we're hearing from government suggests that they're very keen on encouraging wider employee share ownership, perhaps particularly on an all-employee basis, and that of itself should provide some opportunities for change. I've put on the slide there a number of possible areas which I know are close to the ESOP Centre's heart. I'll summarise those very quickly because we're running a little short of time. But for employee benefit trusts, EBTs, employee benefit trusts receive dividends on the shares they hold. But if they pass the benefit of those dividends through to employees, the employees are taxed on that benefit as if it were employment income. So rates are higher and there's national insurance and so on. There seems no reason in principle why, if it is a dividend that's flowing through the trust in that way, the employees shouldn't receive dividend tax treatment. And that would be advantageous. I've referred to the tax treatment of onshore trustees. Again, no policy reason we would think why it shouldn't be possible to align that with the tax treatment of offshore trustees. So there's at least no tax driver to select non-UK trustees. For all tax advantage schemes, but including perhaps specifically SAY and SIP, it would be possible to relax the independence requirement in the context of a company which is controlled by private equity. That the policy behind that would also reflect the current law in relation to carried interest, for example, and that's something for which lobbying has been made for a number of years now. And then specifically turning to employee ownership trusts, there seems to be a legislative oversight in relation to the corporation tax deduction if an employee receives shares from an employee ownership trust. There is no statutory corporation tax deduction, whereas there would be under EMI or SAY, etc. That seems to be just, as I say, an oversight. It would be easy to correct. It would be possible to allow distributions to former employees from EOTs, not currently allowed, and it would increase the flexibility of that vehicle. More controversially, perhaps, where distributions are made by EOTs to employees reflecting the growth in value of the shares held by the EOT, there seems no reason in policy why that shouldn't be taxed as capital. As I mentioned before, all distributions by EOTs are currently taxed as income, but policy would suggest, in fact, capital would be the appropriate tax treatment, and that would be more advantageous. And lastly, a small point, but where shares are sold by employees back to an EOT, but with no reflection of a minority interest in the valuation of those shares, currently there would be an income tax charge. It would be relatively easy to change the rules so there'd be no income tax charge in those circumstances, provided the shares were not otherwise sold for more than market value. So in conclusion, I think it could be an interesting time and maybe even exciting time for all employee share plans in the next couple of years. Next slide, please. Next slide, please. Can I take this opportunity to thank the members of the ESOP Centre for their continuing support. If you have any questions in relation to what I've said today, there will be an opportunity to raise those at the in-person section of the Share Scheme Symposium, which is on Thursday, the 5th of June. Unfortunately, I'm unable to attend on that day, so my apologies for that, but I will be ably represented by my colleague Andy Quayle, who is fully aware of all the issues that I've discussed. So he will be there and available to answer your questions. Thank you for your attention, and goodbye.